Hi, you guys. I'm Phil Town from Rule 1 Investing, and today I want to talk to you about how to spot bad management when you're looking for businesses to invest in. You guys, there are 4 M's to Rule 1 Investing that I'd like you to follow, right? You guys probably know this already if you've been following this. If you haven't, here they are. Meaning, moat, management, and margin of safety. Those 4 things will dial you in to a company that's wonderful and on sale. Now, when you get to the 3rd M, management, you're going to have to make sure that the manager or the management team has talent and integrity. I'm telling you, you really want to get this one right. Otherwise, if this company has debt can kill this business. The management team can come out of it on the other side with more ownership of the business than they had when you went into your investment, and you've just been wiped out. And I'm not kidding. This does happen to people, and it's happened to me. So take a little lesson, earn the hard way, that the management team has to have talent and integrity. Integrity being the key word. I honestly don't mind if they don't have that much talent, because I figure you want a business that's so simple to run that basically an idiot could run it. Because, companies around long enough, eventually an idiot will run it. But if that idiot at least has integrity, they're going to tell you what's going on. And that's what we need to know from them. Now, you get a sense of whether management team has integrity or not by reading the CEO letters. Those are letters put out every year. And by looking at the shareholders report, which is literally just that. It's a report to you, the shareholder. It's called the 10K. Now you can just, one more thing. You can also listen to their quarterly earnings report. Just Google the name of the company, quarterly earnings report, and you can get on and listen to them live. And they'll explain what their business is doing. And then even more fun, you can listen to some of the best analysts in the world who are following that company ask questions of the CEO. Now, you can also feel kind of when you're looking at all this, whether they see themselves as completely responsible to you, the owner, or if they're just giving you the report because they feel they're obligated to do so by law. In particular, I really watch that annual letter to see if they are just putting in a bunch of hype. Which is honestly what a lot of them do, right? A lot of them do. So this is what you need to think about. When you can't understand their quarterly report, if you can't understand what's going on in the company from their annual letter, it's either because the management team is intentionally misleading you by using confusing or vague language to cover up the fact that the business could be in trouble, or they simply don't understand their own business enough to explain it. Either way, you should not be investing with these people, because at this point, you'll basically just be gambling your money that these guys somehow can figure this business out, even though they can't explain it to you. So you guys, here are 5 signs a CEO does not have either talent or integrity, mostly integrity. The first sign is to look for that their paychecks are going up with the size of the company's assets. In other words, if the CEO goes out and acquires a bunch of companies to increase the business value, right? It's just making it bigger, maybe not making it more valuable. They do this often so they can pay themselves more. In other words, hey, now I'm a bigger company and I should compare my paycheck to the paychecks of CEOs who also run bigger companies, right? So we look to see if these guys are just jacking up the size of the company to get themselves a bigger paycheck. See, the thing is, return on investment capital is a key number for you to track with these kinds of guys who are running this kind of company. I say guys, it could be men or women. Believe me, they all do it. You look at return on invested capital and you watch to see, is return on invested capital going down? Is debt increasing? If you're seeing that, you're seeing pay is going up, debt is going up, ROIC is going down, you got yourself a bad CEO. A good CEO's pay is not related to the balance sheet of the company. If a CEO has very little of their personal net worth invested, that's a bad sign. I don't like that at all. It's not a killer, but it's not a good sign. When a CEO is earning $4 or $5 million a year and they're not buying stock in the company, that's a huge warning sign. That means they do not have a stake in this company, or they do not trust that it will do well. And don't go along with the idea that those guys are getting all these options and that gives them a stake. A lot of them set it up so options just come into them for free. They have no real stake in the business. I feel the same way about the board of directors, by the way. Disgust me that boards of directors are out there making $250,000 a year, have free access to the Gulfstream 5 jet, and they don't have a share of stock in the company. All right, a good CEO and good boards have a lot of their net worth in this company. A good CEO has a huge portion of his net worth in the company that he's running. And if he doesn't, what's going on out there is you got a mercenary running that company. All right, the next thing I don't like is that a CEO is selling the company's stock and then says that the stock is undervalued. That is frustrating to me. What is he doing selling stock for lower than it's worth? So let's say the CEO just got a secondary offering, right? And then he sells the stock at 75 cents a share, but the stock is originally worth $1. It was like he thinks it's worth $1, and he sells it for 75 cents. Why are they doing that? Well, they do it in order to drive money into the company by giving people what looks to be a bargain. But what he's doing by giving people a bargain is he's squandering what his own shareholders own by selling 3/4 of what this thing is worth, right? So if they're willing to do that, then the CEOs are basically getting rid of shareholders' net worth at a discount to bring in other shareholders' money. Now this, I grant you, you might have to give people a little bit of a discount to the public price, but if they do a substantial amount of this, you got to really question the integrity there. All right, next, pay attention to the CEO's shareholder letter sounding more like it's a pitch. I mean, basically, he should be writing you a letter that tells you what's going on with the company so that you can figure out the value of the business. Warren Buffett said that if a CEO is willing to mislead others in public, it's very likely he's misleading himself in private. In other words, the CEO is a liar and he's lying to himself too. A good CEO writes a letter every year that tells you enough about this company, the facts about the business, so you can judge the appropriate value for yourself. You want to see a good CEO letter, go read the letters Warren Buffett writes at Berkshire Hathaway. That's how they should do it. And man, I wish we could just, make them do it. I don't know how. If y'all can figure out a way to make them do it, I'm with you. Let's do it. Now, the last sign to look for that I really think is a big red flag is that the CEO is focusing on earnings before interest, taxes, depreciation, and amortization. This is called EBITDA. 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 And when the CEO is focusing on EBITDA, as if that is the same thing as free cash flow or earnings, or even EBIT, which is earnings before interest and taxes. If a CEO is telling you all about in the quarterly report about EBITDA, and that paying interest and taxes and the actual depreciation of the assets don't really have a material impact on the value of the business, that is seriously baloney. Very few businesses are set up like that. I mean, some businesses, like Buffett was talking about at his annual report this year, their EBITDA doesn't even cover that, their depreciation schedule doesn't even cover their real depreciation. You need a CEO who's going to tell you the truth instead of hiding behind things like EBITDA. Now, all these things have a critical impact on the value of a business. When the CEO is excluding them, playing with them, artificially giving you high valuations of the business on purpose, that's because they lack integrity. They're just trying to bolster their own ego. They're trying to push up the value of their options. They're trying to make themselves look good, and they're doing it by cheating. A good CEO focuses on free cash flow of the business and the earnings of the business, not the EBITDA. If you guys see any of these red flags when you're researching CEOs of businesses you want to invest in, believe me, learn from harsh experience. These people are not worth your time, and it's best to move on to the next business. And I got to tell you, if we all did that, if we little guys all took control of our money away from fund managers, away from pension funds, away from all these people who don't care what I'm just talking about, if we all did that and we voted for the kinds of CEOs we should have for our businesses, this stuff would stop overnight. Now, I'd love to hear from you. How do you research a CEO? How do you get the information in the scuttlebutt? Leave a comment below with your answer and I'll be sure to follow up with you. Appreciate you watching this, and now go play. And if you enjoyed this video and you feel it was valuable in teaching you a little bit more about investing or any other way, just subscribe to my channel and share this video with your friends or anybody else that might benefit from this information.